as we move into end of the year in tax planning. And what a great segue, given the reality that for a lot of our clients, because of the PPP loan, if they were able to get through at the time when PPP was coming out, my goodness, looking back on that, it felt like, I'm not going to say the world was ending by any means, but it was intense, especially for us accountants, as we processed these all these different bills that started hitting between the FFCRA, which we'll talk about a little bit more later today, and then, of course, the CARES Act, and then all the different pieces that came on top of that. Of course, all the PPP loan applications, and the business closures, which were really a big deal. And we're starting to see that pick back up again now. So at the time, it was so intense, and never, ever would we have thought that we'd be coming to the end of the year and having to do some pretty intentional planning and having a lot of discussions with clients who have had just some of the most amazing years because of the windfall of the PPP monies. And so with that, we're moving into our year-end planning with a special focus on entities. Of course, you've got flow-throughs on the Schedule C that would come into place here as well. So with that, let's advance the slide here. I think that every single one of these will have the Circular 230 disclosure because they're standalone units. Again, make sure, do not rely on this as tax advice, and have a conversation with us prior to taking action. So with that, next slide. Thank you very much. And so on our entity planning, we really want to just make sure everybody has a thorough understanding that as of today, the PPP loan associated expenses are non-deductible, which basically means it's income for you. And so make sure to get that off the balance sheet. Go ahead and be planning for the effect on the bottom line. Maybe Congress will act. We'll see about that. We'll talk a little bit more about that in the session later today. We want to talk about these tax planning opportunities that need to be undertaken before the end of the year on the 31st this month, and talk about both how to handle a banner year and a bad year. So with that, let's advance. Take it away, guys.
Thank you, CJ. So let's kind of step back like we did for the PPP loan and thinking about the year. We got to go back a couple of years and think about the Tax Cut and Jobs Act that was passed. It feels like it was just yesterday, but it's been a couple of years now. And what an amazing act that was. The most significant legislation, tax legislation we've seen in a long time. For some people, their lifetime. For some of our younger associates, definitely a big change in tax law. And one of the biggest things that came out of that was the favorable tax rates. For those that have C corporations, the 21% tax rate on earnings. Think about that, going from 34 or 35% down to 21, which is a significant cut. Just never had seen the likes of that before in the corporate world. And then on the small business side, the qualified business income, the 199A deduction, the individual rates obviously went down a bit across the board, but you had this qualified business income deduction that, depending on your business and situation and circumstances, obviously we like to talk about the levers around that, generates a 20% deduction. So that could take your 37% rate down closer in line to the 21% rate of what the corporate rate would be, depending on where you fall in those progressive brackets. The cash basis rules were very much given some generous limits there, up to $25 million for receipts over a 3-year period. If you had below that, you can use a cash basis. So a significant increase from the old limits. A lot more taxpayers are eligible for those cash basis tax filings. What an incredible way to defer revenue by being on the cash basis method. Depreciation, finally got some more clarity around the bonus depreciation, at least as far as the 100% depreciation is in the law for several more years. That will start to phase out and reduce down to zero, barring any other type of legislation. Also very generous 179 rules. The limitation is now up to $1 million through the TCJA, but that's also been adjusted for inflation adjustments. So that's up above $1 million right now. So great opportunities to take advantage of currently expensing equipment or other purchases there. The QIP, the Qualified Improvement Property. This is one that we all like to smile about, that knows much about this, that The TCGA thought they were fixing a problem or trying to simplify an area of qualified improvement property of three or four different different descriptions of QIP and made it one area, but they forgot to say it was bonus eligible. So luckily the CARES Act, when it passed back in March, made this QIP property now eligible for bonus, 100% bonus. So the opportunity there is that we can take a current deduction by filing an accounting method change to claim all that unused depreciation in the current year, which might be a great opportunity to reduce income in the current year. So a lot of different changes coming from the TCGA that has been around that we've grown really accustomed to over the last couple of years. So with that, obviously we're now past an election. Obviously things change with elections, as we know. So obviously still a little bit more to know. We have an election coming up in January. 2 Senate races will be decided then. If it goes both Republican or both Democrats, obviously this might be easier or harder to implement based on that outcome. But President-elect Biden has already been discussing some of his proposed tax policy. So it might be a good idea to just discuss the highlights of those before we kind of dig into our further tax planning session. So we just talked about the 21% rate from the TCJA, but that corporate rate is looking to go up to 28%. Several business tax changes out there, incentives. These are really probably less for our client base, thinking about 15% minimum tax on $100 million of income. But changes nonetheless. I think we get the idea from his proposals that there will be changes. There will be opportunities to look for increases in federal tax collections. This third point here, I think, does have a significant impact on our client base is the potential elimination of the 1031 like-kind exchange deferral. This is something that our clients have enjoyed for years. The TCGA did make a change around like-kind exchanges that only real estate after that is now eligible for the deferral. But this is on the table as something that would go away. I would suspect that there will be a lot of lobbying around this area that I think even before my time, CJ, I'm thinking 1031 has been around forever. So I really find it difficult that this would go away, but it would be a easy way to potentially increase income. And then lastly,
and I didn't think that we would see, oh, sorry about that, Paul. In Tax Cuts and Jobs Act, and you know, all of our clients hopefully have been a part of, had a great presentation that we did back at the Embassy Suites, and there's been some recordings out there of it. You know, like-kind exchanges used to exist, though, in all sorts of other areas, right, Paul? We did it for construction equipment and a variety of other factors. But it's already been reduced down to just real estate. It was one of those lasers, a revenue raiser in the Tax Cuts and Jobs Act because it was passed under reconciliation. And so stranger things have happened. We'll have to see what happens. Obviously, the Georgia runoff's a big piece of this whole conversation, but.
Absolutely. The last one there is the GILTI. I won't spend time on that as I don't think it applies to many of our clients here, but I think it's relevant, though, that you can see they are looking for opportunities to raise income both on domestic and foreign operations. So keep that in mind. From the individual side, it looks like the rates are probably going back to where they were prior to the TCGA. It seems to me, though, if I remember the $400,000 top rate, that's probably a lower threshold than it was. But again, the government's looking to raise money. We've all kind of been talking, you know, just kind of casually thinking all these PPP loans and all the trillions of dollars of legislation that's passed, it's going to have to be paid for eventually, along with whatever other policies that President-elect Biden would want to enact. So they are looking for opportunities to raise money. I think the key point here is, as I mentioned, the 199A deduction, the QBI deduction, that is looking to be phased out. This is one, to me, I think it was such a gift to small business owners that, to me, I feel like it's going to be a big push to eliminate that or phase it out. But time will tell. CJ, any thoughts you have specifically on that one?
I'm so sorry, Paul. Repeat that one time. I was answering a chat over here.
Sorry, just talking about the QBI phase out deduction. Any thoughts?
Oh,
on
yeah,
that one?
Yeah, I mean, I don't think we're going to see any changes around that, other than, of course, the reality that Biden would take it completely away. And so the phase out area zone, if you're in the midst of that zone and you're an SSTB, you've gotten above that, then obviously that plays into some of the planning that we're going to talk about here, particularly which I can't believe I'm going to say this, but maybe we accelerate income conversation, right, Paul?
Yes, absolutely. Thank you, CJ. But yeah, big change there on the elimination potentially of the 199 deduction. Capital gains, here's another one for income over $1 million. Think about having ordinary tax rates applied to capital gains. Huge change, huge deviation from prior tax law. But again, as potential revenues are being sought, I think this one is probably directed at hedge funds, and carried interest would be probably where I would see that one being most likely applied. But so far, we haven't heard much of a deviation in capital gains.
Yeah, the big one there, Paul, and hopefully from a client perspective, at least, that there's not going to be a complete run that's going to result, and maybe even selfishly, I don't want to learn a whole new tax act. We've been learning a lot of tax acts the last couple of years. Now that we're starting to get TCJA underneath our belts, all of a sudden that's going to go out and get replaced with a new one. It could be a really interesting year. So maybe out of some selfishness there, but the reality is for our clients, this could be a really big deal, especially when you sell a business, right? And because the general rule is they're talking about taking away the capital gains rate for anyone over $1 million of AGI. And so what that would mean is if you have one of these, hallmark type experiences where you sell your business for 10 million, and there's been no conversations about carving out small businesses or things like that I'm aware of. I think there's been a conversation, but it fell on deaf ears. That would be a really big deal if all of a sudden you sell your company for $10 million, and instead of paying, 23.8%, you're paying 40%.
40%.
That's a big deal.
That is huge. That is huge.
Mm-hmm.
Let's keep our fingers crossed and hope that one doesn't come in. But obviously, all of this is subjective at this point, and we'll see what the future holds.
Yeah. Thank goodness for installment sales, right, Paul?
Hopefully that would work, CJ. Some other credits and deductions potentially being changed. Obviously, for the lower income taxpayers, more credits given there. One of the big things here that I'd point out is the $10,000 cap on state taxes has been a thorn in the flesh for many legislators, especially from highly taxed states that have seen that limit, the $10,000 limit. So I would not be surprised to see that one go away. That one's been yelled about ever since the TCJA was passed. And then that
one's on the chopping block for sure.
Absolutely. Yeah. And then the 28% cap on itemized deductions kind of feels like a little bit of the old limitation, the 80% limitation that used to be around, but definitely some changes there. And then finally, another significant change, payroll tax for income over $400,000. So think about right now, the Social Security, the 6.2%, tops out at the limit of about $130,000. So you would have this nice little donut hole up to $400,000, and then you would start back on the 6.2%. So that could be a terrible change for many taxpayers.
Yeah, that would be a really, really big one, to say the least. Now, something needs to be done about Social Security, but if that's it, get ready. That would be a really big deal.
Absolutely. So with those thoughts in mind, let's think about, again, where are we at? And, thinking for just from a tax perspective, would be a great time to be a business owner for the next 4 years. A lot of changes are coming. We don't know exactly what will be down the road, but changes are coming. And as we think about the political background, as we just talked about, the PPP loans and the forgiveness that Larry has just talked about, it's been a very challenging year for many taxpayers. Some have had banner years, some have had bad years. COVID, it's still rampant. The next few months are very uncertain. So there's just still a lot of uncertainty out there. As we think about our tax planning and objectives, the biggest point that I would make is you have to make sure that you're not doing tax only decisions. You need to look at the big picture. Where are your cash flows? Do you think that you're going to be potentially subject to another shutdown in the next few months? Do you need retained cash? And I say that because a lot of our tax deductions are based upon cash outlays, as we'll talk about some of our tax planning strategies. But to get deductions, generally it takes a cash outlay to achieve those. Generally speaking, and we'll talk a little bit about some maybe exceptions there, but thinking if you feel like your operations are going to be again slowed down or shut down, tax planning is great. Thinking with the PPP forgiveness, maybe you're sitting there with $100,000 of taxable income and you have $100,000 of cash. You may not want to spend $100,000 of cash on buying equipment at this point because you may want to hang on to that. So I just say all this as we're thinking about tax planning. Keep that in mind. There's other business objectives. Tax is obviously one of them. It's very important, but don't let that wag the dog, as we like to say.
That's right, Paul. And kind of just as backdrop, and I'm going to kind of fly us through the next two slides here, if that's okay, Paul, just to make sure we get to some of these strategies. But it is a really good time to be a business owner in 2020. I'm just going to say that right now, because at the end of the day, between the Tax Cuts and Jobs Act, lowest income tax brackets, really great wide graduated rates that are really attractive, QBI, which is just cannot be overstated. Hey, here's an opportunity to only pay tax on 80% of your income if structured correctly for the flow-through entities, 21% for C corporations. We know beyond a shadow of a doubt that 2020 is a great time to be a business owner. You layer a lot of income on top of that, and all of a sudden we find ourselves asking questions. Ben, if you don't mind, advance to the next slide. You layer the income of the PPP on top of it. And we went into this in our previous presentation, but just so it's very clear, even though the PPP income is non-taxable, it effectively is taxable because the expenses as of today are non-deductible. And when is that going to be? As we stated earlier in the previous session, Revenue Rule 20-27, it's right now, it's 2020. And so you have these things that have been built into it. Ben, if you don't mind, advance to the next slide, where you can potentially have a really big year. And with some of the different decoupling with NOL rules and Section 163J and 461 as well, you're in a spot where potentially you can have a lot of income that's coming in this year. And so normally the knee-jerk reaction, if you don't mind, Ben, go to the next slide, and then we're going to get going, is, oh my goodness, I've got a lot of income, and I need to do some serious advanced planning and be able to pull this down as much as possible. But because of all the backdrop that Paul did a great job explaining earlier with the potential for what's going to transpire with the Biden tax reform, and there is some belief that some of these things actually might get through, like that we are actually going to work together between Republicans and Democrats to be able to pass some legislation around some of these Biden tax plans, candidly as bartering points around other issues. And so don't be surprised even if Georgia does go to the Republicans and you have a separation of powers there that are transpiring, where it's not a blue run across both Congress, both houses of Congress and the presidency. There still might be some things that come in. And so with that, let's talk about if we're seeing just this banner year, that's all backdrop. And then we're going to talk a little bit about if we have a bummer year. But if we've had a banner year, it's a complicated time to think about what to do. I'll let you guys take it from there.
I always say the best tax deduction to get is one where you can pay yourself. And I think CJ would agree that. And our very first bullet point here is retirement planning. And what a great way to fund your retirement or your employees' retirements. You defer that income down, but you retain control of that income. So if you've had a banner year, this would be the first area I would say that you need to look at as far as, can we make some additional contributions to retirement plan funding? The nice thing about retirement planning funding too, is I just mentioned, generally you need a cash payment to receive a cash deduction. And that is true here in this case, but a lot of retirement plans, the funding does not have to happen until you file your tax return. So you do have some opportunity for timing of that payment, but yet you can get a 2020 deduction for that payment. And the trifecta, as we mentioned here, thinking between your IRA, 401ks, profit sharing plans, even a cash balanced pension plan, the potential for deferring funds can be pretty incredible. So if you've never really explored this area as the deductions that are available, tune in at 11:30. I'll give a little shameless preview for upcoming presentation, but we'll be going through more of the retirement planning areas, but definitely the first area you should look at is retirement planning. So working across the slide here, delaying income, as we mentioned, the cash basis method of accounting is really a good way to manage your income and your taxable income for the year. And really, the point here is if you have AR out there, think about your GAAP basis financials. You've recorded income and set up your AR. If you're on a cash basis of accounting for that income is not income to you until you actually receive the cash. So maybe you want to be calling some of your people up and saying, hey, I really want to get paid, but please don't pay me until January 1st. And hang on to that check. So if you don't receive that check until next year, you've effectively deferred your income until the next year. But consideration needs to be thought around this, as we just talked about. Where do you think the political landscape's going to go? Where are you on your graduated rates? Maybe you don't want to delay. Maybe there's some reasons to say, no, I would really like to take that income now. So maybe I need to be calling up some of my AR accounts and saying, hey, make sure you pay me before the end of the year so I can go ahead and recognize that. Really, if you think rates are going to skyrocket next year, maybe this is the time to go ahead and collect and get your AR down. So again, as I say, don't let the tax benefits necessarily drive all your decisions. In this case, that would be a similar tax benefit. But, from the same point, if you think the economy and the closures with COVID are about to hit, maybe you want to really focus on collecting AR, especially if you think those vendors or customers might be in trouble themselves. Cash, I would think cash is better than no cash with a bad debt deduction down the road. So just some thoughts around that. And accelerated expenses, same thing on the cash basis conversation. If you have payables out there, you can pay those payables. So if you couple these two, if you're taking your cash payments for income into next year, but you're paying down your payables this year, you're going to get the double benefit of delaying income and then accelerating those expenses. So you can really reduce your taxable income just from the cash basis approach. Some other ways to accelerate expenses. If you have bought real estate or have made improvements, cost segregation studies can be a great way to carve out some of the shorter lived property, get the bonus or 179 deductions on that and take a current deduction on that. So that's a great way to reduce your taxable income. As we mentioned, the 100%.
And Paul,
sure.
Just to speak to that just for a second, I think it's important just to layer in, even though we had a great big huge act in the Tax Cuts and Jobs Act, we had a really big one back in 1986 as well, the Tax Reform Act, that talked about passive versus active income. And so you can't just go out there as a, say you're an accountant by day and a real estate person by night, and that by night is less than 500 hours, then you can't just go out and buy a piece of real estate and then turn around and do a cost segregation study on it and utilize that to decrease your income. Now, on the other hand, if you go out and buy a piece of real estate, because that's passive, just so it's very clear, it by definition be passive, so it cannot offset active, in other words, business income. So on the other hand, if it is utilized in your business in the appropriate structure, then it would not be considered passive. So for instance, you're an accountant by day and you buy a building for yourself for the use of your accounting, and then you turn around and do a cost segregation study on that. That can be utilized as long as the ownership structure is correct in the same space. It doesn't trigger those passive rules. So just want to kind of clarify that for everybody. But some really good news on qualified improvement property, right, Paul? Which we call QIP.
Absolutely. Currently eligible for the 100% bonus depreciation rules. So if you went out and bought a property and then made improvements to that property, all of that qualified improvement property could be written off in the current year. Just kind of a thinking about cash flows and tax deductions. This is one of those areas thinking about depreciation deductions. Again, going back to the example, if you have $100,000 of taxable income and you need $100,000 of deduction, financing your equipment purchase could be an option to do that, right? So you get the current year deduction on your equipment Interest rates are low, so you finance that over the 5-year period, 7-year period, so you can effectively get a tax deduction now and have the cash outlay over the next several years. So, that might be a good strategy anyway if you're looking to conserve cash, but want that tax deduction. And then as the economy or our status is better known as the vaccines and whatnot come out, maybe 6 months from now, you see that your cash position is going to be fine. You can pay that off. So just
That's
another
right.
thought about as far as the depreciation. And lastly on this
Yeah, I
slide,
mean, money right now is about as, I'm sorry about that, Paul. Money right now is about as cheap as it's ever been, and at least in my career. And so by using some of that healthy, appropriate leverage to finance, if you've had this banner year, particularly when it comes to real estate, and it may even be that you need to do that regardless because of the income tax consequences, which gets into this next category of saying, you know what, it might make sense to actually pay the tax, right, Paul?
absolutely. As we said, cash is king right now for many taxpayers. So that $100,000, I might feel more comfortable paying the $37,000 of tax if I'm at the highest brackets, and knowing that I had that $63,000 in my pocket for the unknowns that might be happening for the next few months. So that's always an option.
Yeah.
Like I said, don't let the tax answer always drive your business answers, because you got to stay in business. You have to have inventory. You have to be able to service your customers. So make sure you're looking at all aspects.
That's right, Paul. And and not only is it from a operations and a business and a cash conservation perspective, but also because even at that 30% bracket, which may go up to 39.6, not highly likely at this point, but what we do know for sure is that if you're a QBI eligible individual, business, I should say, that flows through to the individual, you're only paying tax on 80% of that as well. And so at some point, it's okay to get some tax basis in this, unless you can see a really clear path to continue to defer forever. There might be an opportunity to go ahead and just pay the tax this year, depending on where you're headed next year. If all of a sudden, you're thinking next year's going to be a really down year, it's very important to build into all this analysis the effects of graduated rates. But if a lot of our clients are always going to be in the highest tax bracket, and so you got to bake that analysis in. There's not a hard and fast answer to it, but there are some great levers that we can pull between retirement planning. Obviously, if you're accrual basis and $25 million or less in income, flipping to a cash basis could make a whole lot of sense. That's eligible under the Tax Cuts and Jobs Act, even though beforehand, if you triggered went over 10 million, you were forced to move to accrual. So you've got that to build in. The benefit of potentially accelerating depreciation and or just buying good old fashioned assets if you're in this banner year and you don't feel like it's going to be, hey, I'm in the highest income tax, I'm going to make $1 million taxable income this year, but usually I'm at 500,000. Well, this is a year you would want to go ahead and hit those traditional strategies that are going to bring down that income back down to the lower brackets. And so I think that is important to kind of bake in, but not everybody's having a banner year. Some folks are having bad years. So with that, let's move to this last slide here and talk about, some strategies that maybe we have in what I would refer to. I don't know if my brother, older brother, Trace, attorney here in Townsville, I say, well, that would be a bummer year, CJ. And so if we're having a bummer year, some other things that we really want to bring into thoughts.
Absolutely, CJ. So a lot of these are just kind of the opposite of what we just talked about. But from a retirement planning strategy, keep in mind that the CARES Act did have some benefits to allow taxpayers to take $100,000 out of their retirement plans without the penalty. And if you're having a bad year, the tax on that, if you're having losses, that would cover that position. So that might be the time to think about, if you have been affected by the COVID situations, that take out that money. It might be a good area time to do that. Accelerating income. Think about Roth conversions. Again, thinking from a retirement planning perspective, but if you have traditional IRAs sitting out there and you have losses, maybe this is the time to convert. You would have the losses to cover that potential income. And as we just kind of talked about with the cash basis of accounting, now's the time perhaps to be calling up your customers and saying, hey, I need that AR payment prior to the end of the year, and accelerate that income. So another aspect of where you can accelerate. Delaying expenses, as we mentioned too. Don't make those cash payments until next year. If you already have a loss, defer making those payments until January 1st, and then you can get those deductions next year. the depreciation. You needed to buy some equipment, but maybe this is the time to opt out of bonus depreciation or not take 179 on that and just let it run its normal depreciable life. So there's some definite flexibility there. And then lastly, maybe most important for taxpayers that have incurred losses, the NOL rules were, again, given more generous carryback periods with the CARES Act. The TCJA had limited NOL carrybacks to 0, and you could only carry those forward, but the CARES Act reinstated the 5-year carryback. So if you have higher tax years, definitely the opportunity to go back and claim. Maybe even if it's not a higher tax year, if you can go back and get a tax refund and recover cash, definitely that might be the thing to do. The excess business loss rules have also been have been suspended. That I don't think those that really apply to many of our base here, but just to refresh our memory, if you had a loss of over $500,000 for a married filing joint return, you could only take the loss up to $500,000. So in this year of uncertainty and challenges, if you've had a really bad year, a really bummer year, and your loss is over that, potentially you would be able to use that loss. But as the last point here does state, you got to really think about what these losses are. As CJ just mentioned on the property example, it depends on how that property is, what your investment is, how you're involved in that investment, whether you have basis, at risk, passive activity losses, just all the gamut of rules that potentially could limit those losses on your tax return. So you have to keep all this in mind and make sure you're considering everything. So the last point there I would say is definitely talk with your CPA to go over your particular situation and find out what's the best result for you.
That's right, Paul. And don't just think because you have a loss, you get to take it. It's really important to understand it's complicated. And coming back to our previous point, talk to your CPA. Let us run the projections. We've got some great software and tools out there. We're tracking generally for all of our clients, your basis, your at risk, all these different requirements. And so, lean on your CPA around this discussion, particularly if you're having the bummer year. But just to stress one last concept here that's on here. If you have had that super bummer year and you have this opportunity to take advantage of graduated rates, you're always in the highest income tax bracket. You're always over $600,000 in taxable income. You have this year now where you're going to be at, $150,000 of income. Then you pull off your itemized and other deductions, et cetera, AGI deductions, and you're going to be way down there in the very bottom brackets. Well, this is a great year to look at some of those IRAs and convert them to Roths. And because of the Secure Act that came out at the end of 2019, all of a sudden Roth IRAs, they've always been great. And we've always been wanting to try and get money into that sort of category of qualified income. But now they're better than ever because of the prohibition of the stretch rules, or the repeal of the stretch rules that allows you to pick that income up in the next generation over 10 years. And so now a Roth and the ability to convert used to have AGI limits around conversion that doesn't apply anymore. You can convert as much of this Roth as a Roth as you want to. And so if you have an IRA out there, you're having a bummer year and you're going to be in the highest income tax bracket in the past, you're going to be in it in the future, well, take advantage of that to convert several $100,000 into a Roth, take advantage of those rate differentials and then get all that tax-free growth and then the tax-free distributions on the back end. So we could probably spend literally 2 or 3 hours talking about maybe even all day, to be quite honest with you, on tax strategies for both bummer years and for banner years. But that's why we need to make sure we're having a conversation with your CPA. So with that, we need to get to the next session. But Paul, I think you're going to be off duty after this one. Isn't that right? So thank you so much for leaning in a little bit here, brother, and helping bring some of your expertise. But, some significant planning opportunities that need to be undertaken when it comes to tax. Please reach out to your CPA. We got an amazing tax department. Let's run some projections. Let's figure out where we're at and what we can do over the next 30 days, come up with some ideas that are going to be unique to your situation. So thank you, Paul, and thank you, Larry.